Welcome back to my channel. This is continuation of the previous video titled Cash Flow Statement for Beginners. In previous video we looked into the meaning of cash flow statement, why cash flow statement is important and one of the component of CFS which is cash from operating activities. In this video we are going to look the other two components of CFS, which are cash from investing activities and cash from financing activities and the methods of preparing CFS. Now let's get started. Cash flow from investing activities is one of the component of cash flow of a company/business which includes cash generated from buying and selling of fixed assets or non-current assets, investments such as securities, stocks, interest received and proceeds of insurance settlements. Examples of cash flow from investing activities. 1. Purchase of PPE, property, plant and equipment. 2. Proceeds from the sale of non-current assets. 3. Proceeds from insurance settlements for the insured property involved in an accident. 4. Cash payments for acquiring non-current assets. 5. Acquisition of businesses. How to interpret cash flow from investing activities. A negative net cash flows from investing activities may imply the management is investing more, to grow its business. It believe, in future, to generate positive return on the additional investments. A positive net cash flows from investing activities may imply the management is not investing, maybe it believes there are no good investment opportunities within the business. Hence, if so, there should be an increase in dividend to its shareholder, or it could mean the company is not profitable and no longer has the cash to make additional investments. Now let's move to cash flow from financing activities. Cash flow from financing activities is a last component of a company's cash flow statement, which shows the net flows of cash that are used to fund the company. Financing activities include transactions involving debt, equity, and dividends. Cash flow from financing activities provides investors with insight into a company's financial strength and how well a company's capital structure is managed. Examples of cash flow from financing activities. 1. Borrowings debt from a bank. 2. Issuing stocks or equity which is sold to investors. 3. Issuing bonds which is debt that is sold to investors. 4. Stock repurchase. 5. Dividends. 6. Paying debt. Examples 1 up to 3 are the transactions that cause positive cash flow from financing activities, while remaining examples are the transactions that cause negative cash flow from financing activities. How to interpret cash flow from financing activities. 1. A positive net cash flow from financing activities indicate that money is flowing into the company which increases the company's assets. From an investor point of view, a positive net cash flow from financing activities may mean that the company is not generating enough earnings to finance itself. 2. A negative net cash flow from financing activities imply the company is retiring debt or making dividend payments and stock repurchase. An investor point of view on a negative net cash flow from financing activities is if the company is paying dividends, stock repurchase and servicing debt while the company's earnings are underperforming, it may be a warning sign to investors to investigate the transactions. Thanks for watching. Until next time. Please leave a like, subscribe and share.